Welcome into Phil's Tax Hacks and Other Retirement Facts with CPA and personal financial specialist, Phil Putney. Now let's get rolling with today's show. Hey everybody, welcome into another edition of Phil's Tax Hacks and Other Retirement Facts. Back again to talk about investing, finance, and retirement. And Phil, let's talk about the tax proposals. It's moving along. It's gone through the House, or it's moving through the House. I guess now we got to see how it's going to go into the Senate, but that's on the radar this week for us to chat about. You know, corporate tax, all these different things. There's a lot of things that have got people kind of curious as to what we're going to do with it. So what's your take on things? What are you seeing?
Yeah, and just as we talk about it, again, like you're mentioning, to keep in mind, I mean, this is not passed by any means. This is not law.
The time we're taping.
So we're not saying absolutely go act on these events right now, but it gives you a great idea of what they're thinking, what they're trying to push. Just keep it in mind, you know, start giving some thought to the potential of, okay, I might need to be ready to act on if some of these things happen, because I mean, most of them they're proposing to be effective next year. Some of them are proposed to be effective on the date this was introduced. So I think that's like September 13th.
Wherever you want to start. I know the capital gains one seems to be the big one. The corporate taxes. That seems to be the big one because that a lot of people seem to be worried about, because that kind of gets used for job creation. And, you know, I mean, companies pass that stuff along.
Yeah, I mean, this is the poor corporations. I mean, they've been tossed back and forth where, I mean, they had a higher rate, you know, the current tax rate, they dropped it to 21 flat, you know, so it encouraged a lot of change. And you saw a lot of corporations look at moving, you know, certain production and manufacturing back into the US because of that.
Yeah, the Apple thing was massive. I mean, there's
a lot of companies that made huge changes because of this. And now they're looking at flipping it back. So they're taking it from a flat, so the flat current 21 back to a tiered concept, similar to what it used to be, but significantly expanded. So then 18% on the first 400,000 of income, 21% on up to 5 million, 26.5 above that. You know, so it's a significant, obviously they're going after the big corporations. Could be, you know, for smaller corporations, the C corporation might come back into vogue, and actually some planning opportunities because of that 18% rate. Versus a 21. But for personal service corporations, so professionals, you know, so doctors, CPAs, people like that are professional corporations, this doesn't apply. It's going to be the flat 26.5 again proposed. So so, you know, unless you're a business owner, it probably doesn't affect you directly, but ultimately it's going to affect everyone, because corporations are what control industry, everything, you know. So I mean, as they're paying taxes, we've talked about it before, corporations don't pay taxes, they simply pass them through. You know, so if their rates are higher, unfortunately expect to see that kind of flow through to everything. So, well,
job creation, you know, a lot of times can certainly be affected by this. And there's a lot of argument and a lot of back and forth, Phil, on what's needed and what isn't. And I cannot for the life of me remember the term, and I was trying to find it before we started taping this, but I know that when they kind of agreed to the Trump tax cuts, it was this kind of provision or revision or whatever, where it had to be about the tax cuts only. That's why they sunset versus a full implementation in law, and it can't be policy. And I think that's where some of the sticking point right now is going to be too. They're not trying to put in like all these filler things and all this extra kind of want list, I suppose, right?
Yes. I mean, that's how all of these always start is, I mean, it's huge, right? They throw everything in it, and then pieces get cut and it gets, you know, dwindled down. So I would expect a lot of probably what we're talking about is going to make it through, you know, once they end up cutting and getting rid of pieces to try to push it through. So
the stuff like 500 million for the Performing Arts Center, that's the stuff that people get really frustrated about. Whether that's needed or not is not the argument. That can be addressed in another way. It's like
why is it part of a tax bill?
Why is it
has nothing to do with it, exactly,
or a COVID relief bill or any of that kind of stuff. It's like let's be really targeted about what do we actually need. And I feel like the infrastructure one that one made a lot of sense, right?
Right. Absolutely.
A lot of things. I mean, we've still got power lines out there that were installed when Edison was still alive.
Right. Yes. I mean, there's definitely a need for a lot of this. It's just a matter of, like, to your point, I mean, is it appropriate for this? Why not have a separate bill? Let's deal with that separately.
Yeah.
But
so how do
again, like we said before, that's why you and I aren't part of this, because we think too logically. That's not how Congress and, they think. So
I don't know if we talked about this before. Did you ever see the movie Dave?
Yeah.
Kevin Kline in the 90s.
Yep.
He's a lookalike that winds up becoming president, or has to be the president because he's in a coma or something like that.
Yep.
But the best part was that he brings his CPA friend in to help him balance the budget. And I thought that was hilarious. I always think about you with that. He brings his friend in, and they're like, we're going to start cutting things that make no sense. And they're having this meeting, and they decide to cut $40 million for a program, an advertisement program designed to bolster people's feelings about a car they already bought. And they're like, this is the kind of stuff, this is the kind of waste that frustrates Americans. Why are we spending $40 million a year to make you feel good about something you've already bought?
Right. $4,000 for toilet seats and hammers or whatever. All this
stuff gets really crazy. And so we definitely have got to start paying for some of the things that we've done. But how do we do that without totally derailing everything else? And that's the real fear, which kind of brings it back to a lot of what we're hearing from retirees and pre-retirees is like, hey, how much is this going to affect me, and what's going to happen with my retirement?
Right. And I mean, back to the corporate concept. I mean, again, it might not directly affect you unless you have that corporation, but even the market. I mean, market does not like any kind of uncertainty, and this is going to throw some uncertainty into corporations, which is stock. I mean, that's what the market is, right? And they don't like that uncertainty of not knowing what's our tax rate going to be? How is this all going to play out? And the fact that it's not, starting in 2023 or, so they've got some opportunity to plan. It's starting in 2022. So we're talking 4 months, 3.5 months down the road. I mean, it's. So
if we bring that into anything in the individual to kind of ponder.
Yeah, there's all sorts of effects to the individual. I mean, one of them that's kind of interesting is the wash sale rule. And that simply is a rule that applies to stock sales where they're not letting you sell a stock at a loss and then turn around and buy it again, take the loss as a deduction, but then effectively hold the same stocks. I mean, they want you to have if it's a loss, it's got to be an economic loss, meaning, I really lost the money. It's not just paper loss.
Gotcha. Okay.
So, I mean, that's out there. They're not changing that. But the interesting piece is, to this point, that hasn't applied to a lot of other assets, digital assets being one of them. So any kind of cryptocurrency, there is no wash sale rule. So you can do just that. If the market falls in cryptocurrencies, you can sell, all your Bitcoin, recognize a huge loss, and then turn around and repurchase it again. So you didn't really economically change your position.
I gotcha.
But from a tax standpoint, now you've got the significant loss that maybe you can use to offset some gains that happened earlier.
Okay.
So that wash sale rule had not applied to those kind of assets before, but they're proposing that will apply.
I mean, a lot of this feels like Obama era stuff. It seems like a lot of the numbers are sliding basically back to that.
Yeah, and they are. So the top individual rate, 39.6, that's coming back. It was slated to come back again at the end of 2025 anyways, but they're accelerating that. So proposed, and all these, again, we're talking about right now, are proposed to start January 1st, 2022. The top bracket going back to 39.6, similar to the brackets where they used to be before. So 450 for head of household, 425 for unmarried individuals, and then 400 for single head of household and joint.
All of us kind of, I guess, regular folks, right? This is after the rich, I suppose, right? This is
effectively that's what they're going after. And you'll see a lot of it is some of it is ultra, we might consider an ultra wealthy type of person, but I mean, it's for somebody earning, think of that. You get to the 450, 500,000 or above. That's where most of these are really going to come into play.
Okay.
So, and that's what this is. It's just bringing back that 39.6% bracket. So, but I mean, there's, if you had a high paying corporate job and you get bonuses, I mean, that's not out of question, especially for a married couple. You get two professionals.
Yeah.
I mean, it's very easy to get to that point. So.
No, that's a great point, because it's not as hard to attain that number as you realize. Right.
Right.
And it's so And it's not a total accumulation of assets, right? This is income.
This is all income related, right? So far. So,
So far.
capital gain rates, we talked about that, so they're taking that back or taking it from the top is 20% to 25, so again, the same concept, applying where that current 20% bracket starts. So for capital gain for married couple, that doesn't start till your income's above 501,600 this year. So starting next year, you're talking, 501,600, it goes to 25%, which again, you might think, okay, well, that's great. It's the ultra wealthy. Mm-hmm. But okay, think about that small business owner that is now selling their business, right? It's not hard to hit 500,000 in gain if you've had a business and you're selling it.
No, that's a great point.
You could have a year that would push you above that, and all of a sudden, boom, you're, paying now 20 to 25%, which you think, oh, it's not it's only 5%. No, it's a 25% increase in tax.
Yeah.
25% of this. I mean, it's a pretty huge hit. So a couple other things real quick on that, like a business owner. So big planning point for business owners has always been, you go S corporation route, take a salary. Part of the income then is just a distribution of the profit of the business.
Right.
The whole point with it typically is to help minimize your self-employment or Social Security tax. Well, they're coming after that where they're saying, okay, that's fine, you can do that. But now that flow through income you get from your S corporation is going to be subject to 3.8% effectively Medicare tax. So they're trying to generate some more revenue again for higher income.
Because you were only doing, I think, 15% for those types of people before, right? It would come
right. Well, it was that kind of income was just ordinary income. So whatever your bracket was, but it was just the income tax. Now it's that plus this Medicare. So that was the piece before you used to be able to escape it. That's why you didn't take everything as a salary.
Gotcha.
Because you escaped that extra Medicare tax on that piece of it.
And is that still the dollar amount for those types of business owners? Is that still the higher number?
Yeah. So this is 400 for single, 500 for joint.
So you have to make 400
your income
more.
if your income's above that. So again, all these are really that kind of higher income.
But to your point, it's really not that. I mean, even a small business owner, if you've got a decent business, there's a chance that you could be pulling that down.
Right.
Yep. Oh, interesting. What else?
So ultra high income, so now they're proposing this surtax, an extra 3% if your modified adjusted gross income's above 500 or 5 million, so again, but back to the point, if you're selling a business, it might get there. So, the estate tax, what they're talking about there, proposing there is taking that threshold down back to what it was.
Yeah.
So back in 2010, before they had this temporary quote unquote increase, which again was slated to go back at the end of 25 anyways.
Right.
They're accelerating that forward to the end of this year. So taking that back down to the 5 million level. So, we're used to think, 13 million. I mean, that's, you're not going to get there. Well, 5 million, again, business owners, people like that, you saved a lot in retirement, including real estate. This is everything. I was going to say
real estate. Yeah. Property.
Your house, properties you own. I mean, now it's a more attainable number at 5 million. So it's just something to keep in mind that, hey, it's on the radar. It's potentially there. There's a couple other provisions in there that deal with high values in retirement accounts. So again, probably doesn't apply to most people, but thresholds of 10 million, if you have that in IRAs, Roth IRAs, retirement accounts, they're actually instituting a required distribution of 50% of the amount above that.
Oh,
so and this is going to be one of those things. Oh, you've got 12 million in your retirement accounts,
right?
You get to take $1 million out because you've got 2 million over. So you have to take 50% of the excess out.
I see.
So again, and pay the tax, right?
That's what they're after, right? Yeah.
Exactly. They're just trying to say, okay, well, you can't have these ultra high amounts in there. So one that will potentially affect people is this whole concept of Roth conversions and limits on Roth. Which again, I've talked to clients about because it used to be there. Most people don't remember it. Back in 2010, there used to be threshold limits of, if your income were above certain thresholds, you couldn't contribute or even convert into Roth. Okay. Well, they took that away so everyone could do it, so they're basically coming back to that saying, okay, well now again, if your income is above 400,000, 450 for married, you no longer are able to contribute or convert to Roth. So again, back to, you're talking about a lot of the Roth conversion plannings we do. If we're filling up a 25% bracket, you're touching it, right? So we're talking about getting there.
For sure. So maybe a phone call and a conversation about conversion should be higher up on your list of to-dos.
Yes.
ASAP, just in case, right?
And one other interesting one that they slipped in there is it prohibits after tax contributions to qualified plans. So there's a lot of these corporate retirement plans that allow you to contribute after tax money. So you don't get a deduction for it, but it gets to be put into the plan. So it's like almost super Roth, right? So you can contribute a lot of money. It goes into your retirement account. It's no deduction for it. Mm-hmm. And then always the process with that is that when you retire, if you roll that money out, you can roll it directly into a Roth.
Gotcha.
So at the end of the day, you get to move a significant amount of money through this path to a Roth IRA. So they're number one, eliminating that, saying, okay, you can no longer put after-tax money into qualified plans, and you can't convert the after-tax money to a Roth. So they're closing that backdoor Roth concept.
Right.
Backdoor Roth is generally on a much smaller scale.
Sure. Yeah.
But I mean, this is effectively how it's used even at a larger scale. So so bottom line, they're looking at certain pieces that will affect more the average Joe type of person. A lot of it is going to be those higher income individuals. Well,
I think that's a great point. I'm glad you brought that up, because I think a lot of us see the headlines and it's not going to affect the average person, right?
Right.
And so lots of where they go with a lot of the headlines and a lot of the news stories and so on and so forth. And clearly there's some other things in there that can. And it's not too hard to maybe get to some of those numbers. So I know we got to wrap it up this week. But there's a lot of good information in there. We'll probably definitely come back to it once they've finally approved.
Yeah, once it gets closer to the final and we know for sure this is what's in there, we'll definitely touch on it again.
Break them down a little bit more. But if you do have some questions, folks, if you are concerned as to whether or not this might affect you, if you're already working with Phil and you need to reach out to him, please do so. If you're not and you still think, hey, I could be right there at this threshold, let me see what this is going to potentially do to me, make sure you reach out and talk with a qualified professional. If you have an advisor, give them a call. If you don't, reach out to Phil or get a second opinion, whatever the case is. But the stuff is right around the corner. So we'll see what happens in the next couple of weeks. It could be, to Phil's point, it could be sooner than later. So reach out to him at 248-888-7530. That's 248-888-7530. A lot of goings on when it comes to this tax stuff, and we'll see how these things shape out. Go to philstaxhacks.com. Subscribe to us on Apple, Google, Spotify, whatever platform you want to work on. And we'll see you guys next week. We'll be back with another show. Again, philstaxhacks.com. Phil, thanks for jumping on and hanging out with me this week and talking about this highly topical, subject.
Yep. It's coming. So
it's coming. That's right. So we'll see you next time on Phil's Tax Hacks and other retirement facts.
Phil? Investment advisory services offered through AFS Wealth Management. The content of this program is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. Investments and/or investment strategies involve risk, including the possible loss of principal. There is no assurance that any investment strategy will achieve its objectives.